blessed Sunday to you all. I hope you are all still doing good. So, today, this is lesson 6. We'll be dealing with trends because on the last video we talked about candles. So, now we'll be on to trends. Now, a quick recap on our last lesson. We talked about a candle being an indication of price. We also talked about candle moving in intervals for specific time frames. This means that for a candle in a particular time frame, we'll have the opening price, then the running price throughout that entire time frame. Then when the time has elapsed, we have the closing price. So in this section, we'll be dealing with trends. So a trend is known as direction. A trend is direction. When something is trending, it means that it's moving in a certain direction. When fashion is trending, that means there's a certain direction of clothing, which is what can I say? But then I hope you get what I'm trying to say. If music is trending, that means people are listening to music of a certain direction. In a car, everything which is trending, that means there's a direction to it. So even in Forex, things also trend, and those things are candles or price trends, because remember, candles are the same thing. It's a direct proportion to price. Candles are price, just that it's more visual. So let's just see. Let's start by saying we have 3 types of trends in Forex. We have an uptrend, a downtrend, and a sideways trend. So I think some of them are, if not all, they are self-explanatory. We have an uptrend, meaning price is in an overall upward movement. It's going up. Then we have a downtrend, meaning that price is in an overall downward movement. Then we have a sideways trend. A sideways trend, that means there's no overall direction, if I may say. So let's get into how these trends are formed. So remember, we have a bullish candle. We have a bullish candle. For a bullish candle, a bullish or a buy candle, we know that it's characterized by having, let's do this, it's characterized by having a higher closing price as compared to the opening price. This is how you know that this is a bullish candle. You will see when the closing price is higher than the opening price. Remember, at the start of a specific time frame or time interval, at the start we will have the formation of a new candle. That candle will have an opening price. Then during that time interval, it will run. As it runs, price moves up and down, or up only or down only. You get what I'm saying? Then as the time elapses, then we will have a closing price so that a new candle can form. That new candle will also have an opening price, a running price, and the closing price. Another will form just like that. So you can see that it's a sequence. It's a sequence according to the specific time intervals. For 15 minutes, every 15 minutes, a candle will be formed. Then throughout the 15 minutes, it will run Then as the 15 minutes elapse, it closes. For another 15 minutes, a new candle will form just like that. So this is the main characteristic of a bullish candle. We have the closing price higher than the opening price, which means that when the candle opened, we opened with a specific price. Then the bulls, they are known as the bulls. The bulls were able, or the buyers, either way which you understand, the buyers were able to push price up until the close. It may have gone down during the running time, may have gone up and down just like that. But then in the end, when the candle closed, when the time or the period elapsed, it closed with a higher price. The closing price was higher than the opening price. Closing price was higher than the opening price. This is the characteristic of a bullish candle or a buy candle. It shows that there were more buyers for this candle. Let's say price was at 1.4211. If there were more buyers, that means you might find that price is at 1.42, can say 81. So you can see that the closing price is higher than the opening price, and you can add some calculations there. Then you'll find that it's an overall movement. It's an overall movement of 70 pips. It's an overall movement of 70 pips. So price rose or price went up by 70 pips from the opening to the closing price. So let's go to a bearish or sell candle. It's opposite to the bullish or buy. So we'll just use a bearish and bullish so as to not cause any confusion or just add unnecessary words. So let's just stick to bullish being a buy, bearish being a sell. So bullish and bearish. So now we have a bearish candle. This will be characterized by the closing price being lower than the opening price. This is the opening price, this is the closing price. The opening price is higher than the closing price, or the closing price is lower than the opening price. So just like the bullish candle, it will open at the start of that time, then it will run for that specific period, then when time elapses it will close. Just that in this case the closing price is lower. Let's just say we have 1.4980. Then here the closing price is 1.49, you can say 20. You will see that the difference is 60 pips. The difference is 60 pips. So this is a bearish candle. The closing price is lower than the opening price. It means there were more bears or there were more sellers for this candle. They pushed price down until the close of this specific candlestick. Sorry for that. So right now you must have an idea, because remember we said that for every time period or every time frame a new candle will be formed. A new candle is formed when the specific time given for a candle to run has elapsed. When the time is over, the candle will close and will have a closing price. Then a new candle will form. That new candle will have an opening price. then it will run for that specific time frame given, a specific period. Then when the time elapses or when the time is over, it will close to also have a closing price. Then it will continue, just like we said, it's a sequence. It will continue just like that. So usually we'll just take an example of a 15-minute chart. Given this example before, so every 15 minutes a candle will be formed. A full candle will be formed every 15 minutes. Every 15 minutes. But then it's not like this. The candles don't sit like this. Because remember, we have a direction. Remember, we have an opening price. This candle will have an opening price and a closing price. This one will also have an opening price and a closing price, an opening price and a closing price, an opening price and a closing price, just like that. So you find that, let's take an example of a bullish candle. Remember, characteristic is that we have a higher closing price than an opening price. So we have this candle here. We have this candle here. This is a bullish candle. So you find that let's just write bullish here. This is bullish. Sorry for my handwriting. This is the opening price. This is the closing price. So you find that for the next candle, remember this candle will have a running time, then time will elapse, then another candle will have to be formed at the start of the new time. So you might find that the opening price for the new candle is here, where this one closed. So you find that this is the new opening price for the new candle, just like this. Then let's say it runs, then this is the closing price, still bullish. The opening price, you see, I hope you get where I'm going. This will be the new opening price for the next candle. It will run, then this will be the closing price, just like that. So it continues. So what you can see is that the price is moving higher and higher. The price is moving higher and higher. So that means you are having a higher opening price and also a higher closing price. A higher opening price and a higher. This is what we call a trend, guys. This is a trend. It means price is moving in an upward direction. Remember, trend is direction. That means this is an uptrend. This is known as an uptrend. This is an uptrend because price is going upwards. But then, since we know that these are bullish candles, you can also call it a bullish trend. Hope we are still together. It's a bullish trend. So the opposite is said for a bearish. Let's do this. This is bearish. If you can't see it clearly, it's bearish. So we'll have a candle here for that specific time frame. You find that this is the opening price, this is the closing price. Remember, bearish, the closing price is lower than the opening price. So you find that for the next candle, it's like this. This is the new opening price. This is the opening price for the candle. Then this is the closing price. Just like that. It's a sequence. This is the opening price. And this is the closing price. Opening price. This is the closing price. So for a bearish, you can see these. It's composed of bearish candles. So we have lower opening prices and lower closing prices. Lower opening, lower closing. Lower opening, lower closing. Just like that. So this is what we call a downtrend. This is a downtrend because you can see that price is moving in an overall direction which is downwards. Price is going down. So you might find that the price here, if we compare the price here and the price here, you might find out that, let's see, this was 1.6490. Might find that this is 1.6410. This is the closing price for this last candle. So this is a downtrend or a bearish trend. I hope we're still together. Then for a sideways trend, you find that, let's say we had a bullish trend. Okay, let me start. But then this made me realize something. So I think I will forget it. But then, okay, let's hope I don't forget it. If I do, please remind me. Okay, and that thing is about time frames. But then I'll definitely remember it. So, so for a sideways trend, also known as consolidation. Consolidation. Oh, my handwriting. Okay, so it's freehand. I'm not using a pen. Excuse me, guys. So for a sideways trend, you'll find that, let's say we have these candles. Then it's like this, like this, like this. So you can see that we have uptrend, downtrend, uptrend, just like it. So price is in a consolidated manner. It's within a specific range. It's not breaking out. So this is what we call a sideways trend. Yes, there are uptrends and downtrends, but then there's no overall direction of price. It's just going up and down within specific parameters. So it's just like that. We have bullish candles here, bearish, bearish, bullish, bearish, bullish, just like that. So it's just moving in a confined area. So this is a sideways trend. Okay, let me go back to that time frame issue before I forget, and should add gaps. Yeah, after the time frames, I'll add gaps. You might have noticed. You might have noticed that when I was giving an example of a bearish, I also included price. So let's just take that bearish movement. It's also the same for bullish, just that the price will be higher. The final price will be higher than the initial price for that trend. So let's take bearish. I gave an example of candles going down, just like that. And just know that sometimes won't be like this. Sometimes won't be like this. Remember, we deal with the overall movement, because sometimes you might find out that it's like this and comes up, goes down, and like this. But then you can see that overall price is moving down. How can you know this? You take the initial price, let's say it's 1.64, right? I like this price, 6490. Then the final price, you take it as 1.6410. That's where you can see that there's been the price has moved down by around 80 pips. Price has lost 80 pips, or the currency pair, because remember, these candles are for a specific currency pair. The currency pair has lost 80 pips. So with this being said, this brings me to time frames. I want you to follow me. It's going to be a bit confusing. But then this is also aligned with time frames. let's say for a bearish trend, let me just write BT. For a bearish trend, you find that things are moving. Let's see. This is a candlestick for 15 minutes. 15 minutes. Another 15. Another 15. Another 15. Yeah, let's just put it this way. So these are bearish candles. They are overall bearish candles. What you'll realize is that this is 15 minutes, remember. This is another 15 minutes. Sorry for that. 15 minutes. This is another 15 minutes. This is another 15 minutes. What you'll realize is that if you add all these 15 minutes together, they will give you 1 hour. It's for 15 minutes. Do you see this? Then, if you move to a 1 hour time frame, you'll find that all these 15-minute candles formed one candle. Follow this. Just look at this. Just look at the beauty of this. All these 15 minutes formed this candle on a 1 hour chart, because it's logical. If we add these 15 minutes together, that means we'll have 1 hour. So like I said like I explained in the beginning, bigger time frames have lesser candles. So as you can see, if we compare 15 minute to 1 hour, the bigger time frame is 1 hour. The 15 minute is smaller as compared to the 1 hour. That's why a 15 minute will have a candle forming every 15 minutes. But then for a 1 hour, a candle will be forming every 1 hour. So that means a 1 hour candle will be composed of 4 15-minute candles. And just like I said, the price is not what happens. The price movement on 15 will be on 1 hour, 4 hour, 1 day, or anything. Doesn't mean that since now we are on 15, when we change to 1 hour, the price is different. When we change to 4 hour, it's the 4 hour time frame, the price is different. When we go to 1 day time frame, no. Let me show you how. Let's say we had this price of the initial price of 1.6490. Let's say we had this initial price of 1.6490. Then we had the final price. Remember, it's not final as in final. Let's say for your analysis, at the current moment you found that the price, the final price for the current analysis, the final price was at 1.6410. It will be just like this on the 1 hour. It will be 1.6490. Then here the closing price will be 1.6410. Just like that. Just that for the 1 hour. For the 1 hour, it was the opening price and the closing price were for one candle. But for the 15 minutes, there had to be a trend. So you witnessed a downtrend on the 15-minute chart, but then for the 1 hour chart, it was just one candle. But then if you observe, the prices are the same. The prices are the same. So if we take 4 1 hour candles, you will find one candle on the 4 hour chart, but then 4 1 hour candles on the 1 hour chart, because a candle is formed every 1 hour. I hope we're together. So yeah, this is it on how the time frames link with each other, and also the trends. So I hope you got this. Then let's go to gaps. Remember, we said that time has to elapse, whether we like it or not, whether the market likes it or not. For a specific time frame, a candle will be forced to close. For a 15-minute time frame, every 15 minutes, a candle will have to be formed run then close, then for the next 15 minutes the same. It's a sequence. So you might find that, okay, this candle was still running. Let's take this as a bearish candle. It was still running, and there was much selling pressure. There was much selling pressure. People were pushing the price down. Let's say it's 1.6490. People were pushing the, not traders, yeah, call them traders, were pushing the price down. As the price was being pushed down, there was a higher selling pressure. You find that the 15 minutes is over. It's over, but then selling pressure was still high. The 15 minutes is over. That means a new candle has to be formed. A new candle has to have an opening price. So you find that in this case, the closing price was 1.64. Let's say 70. You thought 10? No, it's 70. So let's say the closing price was 1.6470. But then a new candle is to be formed, and there's still pressure. You might find that the new candle will open here. The opening price usually should be 1.6. Remember, the closing price of the last candle should be the opening price of the new candle. That's how it usually is. But then you find that in cases of high momentum or high pressure, it's either buying or selling, there will be gaps. That means price will gap down. In the case of a bearish momentum or selling momentum, increased selling pressure, whatever you may call it. So you might find that this new candle has an opening price of let's say 1.6440. This is what we call a gap. This is what we call a gap. Means price gapped down in this situation. As you can see, the closing price of the previous candle was 70, and this one is 40. That means we had a 30 pip gap in this case. Price gapped by 30 pips. It gapped down by 30 pips. Then this candle will run, then to close. Then depending if it's a normal market conditions, there's no increased momentum of volatility, you might find that let's say it closes at 1.6410. The next candle to open will have an opening price of 1.6410, which is the closing price of the previous one, which is this one. So there were no gaps, but then we might find that there's a gap. So let's deal with the gap down and the gap up. We have two scenarios. It's either the gap down. Let me start with the gap down. Gap down will happen if the closing price of the previous candle is higher than the opening price of the next candle. This shows that let's say we had this. Let's say we had this, because a gap down can also happen in a bullish trend. Let me show you an example. Let's say this is a bullish candle. This means this is the opening price. The closing price is higher. So usually the opening price should be on this level as the closing price. But then you find out that the opening price is lower. The opening price for the next candle is lower, whichever direction we take, but then the opening price is lower. The opening price is lower than the closing price of the previous candle, or the closing price of the previous candle is higher than the opening price of the current candle. This is what we call a gap down. It shows that price gapped down. Let's just see the closing price for this Okay, let me just draw these two candles. Let's say, name them 1 and 2. Let's just say the closing price for candle number 1 was 1.4630. We expect the opening price of candle number 2 to be this 1.4630, but then due to volatility, momentum, which whatever you may call it, the opening price is not 1.4630, it's 1.4620. You see, it has decreased. That's why we call it a gap down. That's why we call it a gap down. It happens in, it can either be a bullish trend or a bearish trend. So this is a gap down. We say price has gapped down. So this is a gap down of 10 pips. If you can calculate 30 to 20, that's price has lost 10 pips or moved down with 10 pips. The currency pair has lost 10 pips. So this is a gap down. Then let's go to a gap up. It's the opposite of a gap down. It means price will go up by a certain number of pips. So let's just see. This will happen when the closing price, or should I start with the opening price? Whichever way, as long as you understand the closing price of the previous candle is now lower. It's now lower than the opening price of the current candle. So let's just say we have two candles. Which candle should I? Which type of candle should I make it? Let's just make it bearish, for argument's sake. So this is the opening price. This is the closing price. Because I don't want you to cram. I don't want you to think that a gap up only happens for bullish candles or for bullish trends. Then a gap down is for bearish candles or bearish trends. No. These happen in all situations. A gap up may be found in a bearish trend. So right now this is a bearish candle, right? Let's just say we are in a bearish trend. So you'll find that for the current candle, this was the previous candle. For the current candle, which is opening, we call it, this is candle 1. The previous candle is candle 1. For the current candle, which will be candle 2, you find that the opening price is higher. It's higher than the closing price of the previous candle. So we find, let's just say that closing price was 1 point. Let me stop using one. Let's just say 12, because price can be any value. Depends on the exchange rate. 12.3640. Then usually, like we said before, the opening price should be equivalent or should be the same as the closing price. Okay, the opening price of the current candle that we're dealing with should be the same as the closing price of the previous candle or the last candle in the time frame. So you find out that it's not the case. It's 12.3670. So you can see that price has increased. It has jumped up. So this is what we call a gap up. Right now we say price has gapped with, if you do the calculation, it's 30 pips. Price has gapped with 30 pips. It means price has went up. The opening price is higher than the closing price. So this is a gap. So you might find that it's a gap of 30 pips. Usually you'll find them during high volatile situations like fundamentals, or also when the market opens. When the market opens, it can be at the beginning of the week or at the beginning of every day, because I know we said that the market runs 5 days in a week. It's 24/7, but then there will be a specific time frame. No, not time frame. There'll be a specific point in time whereby a new day begins. And when a new day begins, you find gaps. The market is still running, but then there's what we can call it a turnover for the day. That's where you get your swaps calculated and all those things. Spreads are increased. It's usually is at 5 p.m. EST. It's New York time. Then in South Africa, it's usually around 11. You know, it's usually at, yeah, I think it's 5, yeah, it's 5 p.m. New York time. So it's that's I don't know how to put this, but then I just hope that you get what I'm saying. When I say day start, it doesn't mean that the market will stop. Then no, the market continues running. Just that the prices will be different. The conversion will start being different. That's where you'll sometimes experience gaps, but then it's not always the case, because sometimes it just continues. You find that there's no gaps. If the gaps are there, they are